Hi, everyone. It's Rick Bensignor. Happy New Year, and welcome to our first In the Know Trader show for 2020. We've had a couple week hiatus as both myself and StockCharts kind of took vacation from putting out weekly podcasts, and we are back and ready to go, and certainly lots to talk about and go over today. So here's our agenda. You'll see there's more than normal that we're going to go over. So first, just some upcoming public appearances that I have. I will be interviewed on Bloomberg TV on Wednesday, January 22nd at 2:30 p.m. I will be speaking at the Orlando Money Show next month, just about a month from now, on Saturday, February 8th at 8 a.m. You can find out more about this terrific free show that generally attracts many hundreds of people to it. It is one of the big money shows of the year. So please go to the link in the knowtrader.orlandomoneyshow.com, and you can find out about what I'll be speaking about, as well as information to sign up. So that's a good link to use, in the knowtrader.orlandomoneyshow.com. This week, we will take a look at the macro sector relative performance chart, as we normally do, but with a little twist. So we'll take a look at that. We'll review the S&P and what's going on in the market. As I record late morning on Tuesday, the S&P currently is down 5 points on the day, so it really hasn't moved a heck of a lot when you think about what's gone on since Sunday night and the market's reactions to the Iran, we'll call it crisis or situation that the market had a chance to react to on Friday, and then subsequent, we'll see what's going on. And then the rest of the show, we're going to talk about a couple of things. One is the ability to exploit others' mistakes, because that really is how you gain profits in the marketplace, is taking advantage of other people's poor decisions. Essentially, that means that I generally look to buy low and sell high, which is what you're supposed to do, but so few traders actually end up doing that. We'll take a quick look at what an In the Know Trader weekly report looks like, and I'll give you a little information about a brand new newsletter that's coming this quarter. So let's start things off. Oh, I've got the slide here, by the way. How to contact me. It's rick@intheknowtrader.com. We have a website, intheknowtrader.com, that you can find out a ton of information, including there's videos on trading tips, lots of videos I've done for realvision.com, interviews on TV, so my thoughts on the market from various time frames, as well as how to sign up to be an In the Know Trader client. So let's start off with the sector performance. And normally what we do each week is, on the left-hand side, we have relative performance year to date from up to the prior week, and then through yesterday. But because we're at the beginning of the year, what I want to do is just take a look at S&P relative performance from last year. And so the difference here is that on the left chart, I've changed the default settings from StockCharts to be the cash S&P index, along with all the cash S&P macro sector indices. And I'll explain in a second why I did that. On the right-hand side, I have the spiders, the ETF that tracks the cash S&P index, and all the ETFs, all 11 spider ETFs that track the macro. The default setting on StockCharts, and I've actually mentioned it to them, so hopefully in a very short tune it can get changed. A reader or a viewer, either way, very keenly pointed out that the default settings in the perf chart has the cash index, but then all the spider ETFs in relation to it, and that is comparing apples to oranges, because the spiders include dividends, whereas the cash does not. So what I've done here is shown you either the the actual returns of the cash indices on the left-hand side, so that's the raw return of the actual underlying index, and the right-hand chart includes, because each one of these ETFs includes getting dividends, the dividend, the total return for each sector. And this week, the ones with the green dots are those sectors that got material returns added because of dividends. So for instance, if we look at consumer discretionary on the left-hand side, the second vertical column, the kind of the navy blue, you see that the actual cash return was 26.2%. If you look on the right-hand side, consumer discretionary with dividends got you 28.4%. So it got another 2.2% because of dividends. Materials, which were up 21.87, so almost 22, got over 24% with materials. So you can see really where the dividends made a big difference last year. So something even like energy, the worst performing sector from last year, was up 7.6%. But with dividends, you got 11.7%. You got over 4% in dividends from energy. So even though it still was the worst sector with dividends, it wasn't nearly as bad. So the point here is that you need to make sure that when you do these perf charts, that you're looking at apples to apples and not apples to oranges, and therefore either use all the cash indices or change the default setting from the cash S&P to the spiders, along with the spider ETFs, and then you'll get the correct information, because that'll include the dividends on the full S&P itself. So you'll have an apples to apples comparison. So as the month progresses, we'll switch back to looking at week over week to see where the changes are. But I thought, when you look at last year, two things come up as being rather important in looking at these charts. The first is where you actually collected the most dividends. Secondly is to show you how a sector like technology, which has so many large cap names and represents such a significant portion of the total S&P 500, can really skew one sector, skew the returns of everything, because the S&P Technology Index was up 48% before dividends. And that made a significant change to the overall S&P performance. Most of the other sectors, barring energy, were somewhere in and around. Look also how few sectors outperformed last year. Without dividends, the only two sectors that outperformed were tech and communications. Well, I say it, there's actually three: communication services, and it looks like financials just beat out by, 20 or 30 basis points. So very few sectors outperformed, most underperformed. And again, it's the weighting of tech and how influential it is that made the results look as they did. But most of the sectors underperformed last year. And with dividends, let's see, looks like only two outperformed, which would be financials and technology, with communication services getting pretty close, but not quite. So anyway, that's a look. We'll go back to comparing week over week as this month goes on, and we start getting results of how the market's trading this year. But that's how I wanted to start things off this year. And so S&P 500, you can see, has last week made new all-time highs. Now, there is a particular pattern here, and if you've watched and listened to my shows from the last year or so, that one of the models we employ is a model designed by Tom DeMark, and you know that when you have setup nines, which are these blue nines, or setup 13, countdown 13s, there are often times that identify high risk to playing the direction of the trend. And you can see that going back to May of 2018, actually, we had confluent signals show up. We had a month-long decline. You had a setup 9 count here a few weeks before the big decline. into the fall of 2018. This 9 count didn't pause the market. This 13 count certainly did in the summer this year, where we had the sell-off that lasted over the summer. And then we have one over the last in mid-December or so, and that's part of the reason why I've lightened up some long exposure with institutional clients. I'm still net long to either add to net longs or hedge books. But my feeling is you basically always want to be fully long stocks, and then as a fund, and then you pick the points in which you lighten exposure by either using futures or doing something that would suggest that you don't want to have maximum leveraged exposure. So I'm essentially always or darn close to always 100% long the stock market, and then I overlay hedges where I feel that it's the right time to do so. So we are still long the market for institutional clients, but what I did is I cut down exposure to 25%, which really in theory is 125%, because again, you're always long the underlying stock market at its full capacity, and then you just lay on hedges where you need to. So we cut down exposure from 175% long to 125% long this past Sunday night, just given the Iranian situation and the chance that we kind of think that Iran is going to do something in retaliation. They said they will, and it's just a matter of when and what, and the extent of it and how the market takes it. So far, there's really virtual no net change. You can see we're trading where we closed virtually last week and the week before. So, there's really been no advancement. And I guess what's significant is we also haven't seen any particular significant decline off of the news. And that says that there's still bullishness in the market. Oil rallied, but then, now it has an advance. It's over $2 off the high of the move, which came overnight yesterday. Gold certainly had a very significant rally, but it's pausing here. So, the way I look at this is, and you'll see as we get into the In the Know Trader newsletter a little bit later on, is that we are basically always long and look for the market to go up. I'm a long-term bull. Occasionally we'll lay on a hedge, or what we'll do is buy an ETF that inversely tracks the market or potentially takes advantage of a down move. And as I said recently, we were long, I think it was we were long the inverse of the Russell 2000, which basically means that the ETF would make money if the Russell 2000 went down. And I did that going into what were, let's say, a week or two before the scheduled December 15th increased Chinese tariffs, which Trump did remove just beforehand. So we lost money on that trade. And as I said to clients, I gladly lose money on this trade, because if we lose money on something that bet the market was going down, the bulk of our portfolio, which is long, is making money. So, we pick our points in which we think there's better than average times to do a little hedging. But otherwise, I like being long the market. And, we play accordingly, and we also have sell stops in at the right places, such that if things do turn around, we don't give back everything that we're up. So once we start making money on a trade too, I generally raise the sell stop to break even, which greatly decreases the odds that you can lose money on a trade. So anyway, I'm still generally favorable to the market. I have lightened up a bit up here, but I'm still a long-term bull. Despite everything going on, this market doesn't really sell off. And right now, I would kind of use the 3110 level as, Friday closes beneath 3110 would likely disturb me. Otherwise, I stay long the market. Okay, that's mostly what we're going to do. We're kind of halfway into the show. And that's mostly what we're going to do as far as taking a look at charts this week. So unlike most weeks too, where we'll pick a sector or some part of the market and kind of deeply delve into, This week, we're going to do more about talking about the idea of exploiting others' mistakes, take a look at how results have been last year, and we'll take a look at a couple of like the ongoing in the No Trader product, plus just generally throw out the idea that something new is coming down the pike. So let's go back and talk a little bit about the advantage of exploiting others' mistakes. So the results here on the right-hand side of the screen are from the Bensignor Investment Strategies side of my consulting business. This is my institutional results from last year. I put out 28 formal trade ideas in 2019. Collectively, if you look at the results of all the gains on those 28 trades minus all the losses, you actually had a 112% return on invested capital. Now, that is not comparing how we did to the S&P. This is a return on invested capital, or also called an internal rate of return. This is not a diversified portfolio that's always invested. It basically assumes that when I put out an idea to an institutional client, they have cash in order on hand to be able to put in to the market and make that trade. Whether it's a long or a short idea, there is, let's just assume, cash available to make that trade. So this is not saying that you would have made 112% on a diversified portfolio. The portfolio is not invested throughout the year. If you gave me $1 million or $100,000 or $10,000 on January 1st of last year, I'm not saying you made 112% on that. I'm saying that each time we made a trade, collective of these 28 trades, 16 were winners. I think it was, let me think, 16 were winners. There were 7 losses and 3 break-even trades. But collectively, if you look at how much you made on all the winners minus how much you lost on the losers, you made 112% on the capital that you put to use. More importantly than that, even, is something called a profit factor. And a profit factor is not something most people on the retail side of the industry know, but it is one of the most important metrics on the institutional side for a portfolio. And it is the ratio of dollars made on your trades to dollars lost. So if you had a profit factor of 1, it means you made as much money as you lost, so you made no money. A profit factor of 2 means you made twice as many dollars as you lost. And that is a minimum that any money manager would look for. Let's say hiring somebody, or if they were going to use an outside fund, they want to see a profit factor at least of 2, saying you make twice as much money as you lose. Above 2 is considered good. 3 is considered close to, I'd say, very good. So if you make $3 for every dollar you lose, you've done very well in the market. My profit factor for last year was 7.28, meaning you made $7.28 for every dollar you lost. That is very, very, very good. We also, so besides those 28 trades, I also guide my institutional clients on how to tactically have exposure to the whole market itself. In 2019, that guidance outperformed the S&P by 548 basis points, or it's 5.48% on top of the S&P's return. And it's not 5.48% of the S&P, it's on top of. So if the S&P made 28.8% last year, this is 30, what is this, 28.8? This is over 33, this is over 34% that we made last year, if you followed my guidance on how to be positioned for the market. And then I also guide hedge funds on there. So again, many of you don't know this, but a lot of hedge funds out there are what they call long, short, or equity bias neutral hedge funds. They basically buy a stock and sell a comparable stock against it to take away market risk, and then it comes down to the performance of what they're long versus what they're short. For example, if you were long Home Depot, and let's say we're short Lowe's, the home repair store like Home Depot against it, that would be a typical type of pair trade in a long-short portfolio. So generally, you don't care which way the market goes when you have a paired book. You just care that your longs outperform your shorts. In other words, that your longs go up more than your shorts go down, or your shorts go down more than your longs go down. Did I say that right? Your shorts go down more than your longs go up. Either way, they have paired books. It could be like buying Coke and selling Pepsi, buying McDonald's and selling Wendy's. And they do this throughout all the sectors that they specialize in, and they find their favorite names, and they'll go long those, and they'll short the ones that are their least favorite names, looking for the better fundamentals and stock and companies to do the ones they're long better than the ones that they're short. And the reason I bring this up is, again, advising hedge funds over the course of the year, I had them long the market 1.45 times what they were short. So in an up year, that also was that's a mega home run. Now, this is not a one-time thing. As good as we did last year, and it was our best year ever, in 2018, which was a year the market was down, but again, I'm not benchmarking myself against the S&P, but we know the market was down in 2018. The trades I put out last year, and there were 30 of them, collectively made 24.3%. Profit factor was 1.73, so not nearly as good, but still obviously positive. And then in 2017, on 36 trades, we made 75% with a profit factor of 6.67. So again, you made $6.67 for every dollar you lost. Why do I bring up what I did on the institutional side for the In the Know Trader podcast and show? Well, it's because I use the same models that I use for institutional clients to deliver performance for and trade ideas for the In the Know Trader weekly newsletter that I write. Now, I don't put out the same trade ideas because I'm not going to mix what I do for institutions with retail. So I always come up with different ideas for them. And I'm not saying performance is the same. What I am saying is I use the same models, the same 40 years. Yeah, I'm now in my 40th year on the street. So I use the same models for In the Know Trader that I use for Bensignor investment strategies. And that's the advantage and why I came up with In the Know Trader a couple of years ago. I've told you before, but many of you are listening, let's say, for the first time or recent new tune inners. In the Know Trader was developed by me to give retail investors access to the same models that institutional traders use in order to get some of the results they do, and to be able to essentially buy low, sell high, what you're supposed to be doing, but again, so often different than what people actually do, and to be able to understand thrust in the market, when to play with the trend, when to not play with the trend, and how to buy when other people are kind of dumping out of positions where they can't take the pain of loss anymore, and we can identify that and come in and buy what other people don't want, because the models I use suggest that that underlying stock or ETF or commodity or currency or whatever it is that we're trading is likely exhausted to the downside, and we'll step in. So here's an example, and I was just quoted in Barron's in this the last week of December. The XOP ETF, which is the oil and gas ETF, had a terrible, terrible year. As we know, energy was the worst performing sector. I was actually short the XOP for a good chunk of the year as a pair trade against being long solar. The ETF was tan. So our best trade last year on the institutional side was long solar and short oil and gas names against it. We put that on in February. We took it off in September. and if I remember correctly, made about 35% on a pair trade. So again, which is huge, because a pair trade is essentially neutral. If you had two equal performing companies that mimicked each other, whether the market went up or down, you'd still make essentially nothing. The fact is, I was able to determine that solar was the place to be, but instead of just being outright long solar, I hedged it by being short oil and gas names against it. What worked out very well is that not only did solar go up, but oil and gas names went down. So I made on both sides of that pair trade, not something you typically expect to be able to do. So I was short XOP almost the whole year, and yet in late November, we went long the XOP in the $20 handle. And now I think it's, let me take a look today, I think we're in the $23 handle. So yeah, we put a double position on too, twice as much as we normally would in that trade, essentially bottom picking. So right now, the XOP is trading at 24.12. So we're up over, I'd say it's just about 25% on invested capital, just as the rest of the street is waking up to the idea that energy names are bottoming. That's the advantage of doing what we do, is that we're long before the whole street wakes up to an idea of something, because we were able to identify and spot the bottom when it was happening, as compared to afterwards and saying, oh, look, XOP bottomed at, $20 and I don't know, 20 cents or something like that, or 19. It was right around the $20 level. Now it's trading 24. People going, oh, maybe energy names have finally bottomed. So that's the advantage. That's what I talk about, exploiting other people's mistakes. So the other thing I want to do here is show you what an In the Know Trader weekly newsletter looks like. So it's called the Tactical Trader Report. And again, this is for tactical trading. This is not for investing. You're investing, you should, be invested in the market. This is play money. This is what you want to trade with. And it's designed for traders and people who generally want to hold things for weeks to months, not years. Again, this is not an investing newsletter. It is a trading newsletter. Each week we start off kind of with the big picture, what's going on in the markets. We specifically hone down to the S&P, and I give you my positioning for the S&P because that is the benchmark index and how we expect you to look at the market, not the Dow Jones, but the S&P. That's really what matters. I give you a new trade idea. This newsletter was the last one we wrote for the year before I went on vacation. So this was dated December 19th. It actually got you into an ETF that tracks Vietnam. First time we had gone into kind of really a frontier type market. And that's up, I'd say probably about 5% currently in less than a month. Certainly better than what the S&P has done in a month. Then we review every open position we have that's still open on the books. And we show you charts, we give you updates, we change stop outs and targets as needed, but we go through our entire book of names, everything we have until the position is closed out. And even something like PBW, which is a name we've had since February of last year. So we got along in the 26 handle, and we've traded in and out of it, but I've also always told you, hold a piece of it for the longer term. I think that it's moving well higher. So that's pushing up, et cetera. So I'm always going to walk you through everything we have until it's all done. So that's kind of a look at In the Know Trader. And we'll get, we don't have time this week, but in next week, I'll start telling you a little bit about this new idea that we're going to have for a piece that you're going to love.